Welcome to the Become Sensible podcast, where we discuss practical accounting, finance, and tax for everyday business. I'm your host, Fiona, and I'm here to show you that no matter what your business financial situation is, you can change it. Good morning. Thank you so much for tuning in to the episode today. As you know, last week we talked about the financial report and specifically the profit and loss. Today we talk about another very important financial report that is the balance sheet. And I know many business owners normally don't pay attention into it because I think probably on the markets, on online, not many people actually mention about it, but this is one of the most important financial report that you need to take care. The reason why is if you need funding, you need like investment from the investor, venture capital, angel fund, or like you need a bank loan or you need SBA loan, any type of financing, these potential investor and banker they will need to look into your balance sheet because it shows the health of your business financial as a certain period. So we as professional accountant, we also look at the balance sheet because many people don't pay attention in the fact that anything on your profit and loss at the end of the day it will move it and it flow into the balance sheet, and when we look at it we will see a very detailed financial picture of your business. So let's dive in. And I always start with basic about the financial report, about the information that we talk about. And then after that, I talk about the practical, how you apply it and how it's become like using in your real daily financial activity of your business. So in personal finance, we have the thing called network statement. So in the business, it's called balance sheet. It's actually simple that way. So in the balances, it has three parts. Number one is assets. Number two is liability. Number three is equity. So what's including in the assets? Assets is first is the cash, and anything that cash equivalent, such as investment in stock, bond that you're holding under the business, is also called cash equivalent. Number two is account receivable, which is like after you sold a product, you perform a service, for example, like doctor, lawyers, they you need normally like need to bill out. They send the invoice to your customer, your client for the work that you already done for them. That is called account receivable. Number three is inventory. So if you make the products or produce product, normally inventory is these areas or you have a merchandiser. So you use your cash to buy the inventory, buy the product, and they sit in the inventory until you sold or you sell that product and it generates into become like a cash. Number four in the assets is long-term assets, which is can be like building, land, equipment, anything that it will like potentially depreciates, such as like leasehold improvement or equipment. So that is total assets. Number two is we talk about liability. So what is liability? Liability including like short-term liability and long-term liability. Short-term is the thing that you need to pay for your vendor, the liability to the credit card company, any like short-term loan. So normally short-term liability is under 1 year. And then we talk about long-term liability, which is like is more than 1 year, maybe that is bank loan, that is business owner loan to the business itself. Any type like SBA loan is also considered is a long-term loan, depends on the loan terms. So that's the liability part. And then we talk about the equity. Equity is always start with the beginning investment into the business. That is the beginning amount of money that you put into the business, maybe 5,000, 10,000, 50,000, or whatever the amount it is, that is beginning investment. And then during the year, if you make any investment during the year, that is additional that during the year investment. And then like any net profits from previous year that it rolled over to this year is called retained earning under your equity. So you plot this together, and then any profits or loss that you have during the year, it will also sit down. If you have a profit, it's an plus. If you have a loss during this year, is a minus. And then that will get you to like ending balance of equity. So in the balances, basically it needs to be balanced. It needs to be like have assets equal to like liability plus equity. So if your balances is not balanced, that's a fundamentally wrong in terms of accounting. And I know it's so basic, but I can say to you that there are so many business owners come with the balances is not balanced because if you take care of your accounting and financial record on a spreadsheet, there's so much easy for you to actually make a mistake and errors in terms of balances because the rule is accounting always double entry. You debit something, you need to credit something. And because if you track your financial based on a spreadsheet, you actually don't do the double entry, and that is why on the balances sometimes it's create a unbalanced balance sheet. And if you have an unbalanced balance sheet, we cannot use this for anything at all. Okay, so if we have a assets equal liability plus equity, so any equity equal assets minus liability, and that is a very important thing to pay attention. Here's a few reasons why the balance is very important, and I can show you what most of the investor, the banker, they will look at in like the balances will show how much cash and other liquid asset that a company has on hand. So it indicates for the potential investor or like the banker to see whether you can meet the requirement. You have enough money to actually meet the requirement of short-term debt obligation. Is mean like if you have enough cash to handle the payment of short-term debts in the next 3 months, 6 months, or under a year. And that is very important because if you don't have enough cash or equivalent cash to take care of those obligations, they don't want to lend you the money because it's very high risk that they probably will never actually can get that money back. Number two is the leverage. The balances show you how much debt a company has relative to its equity. I don't mean that debt is bad. There's so many type of debt and depends on the industry. You actually also need debt because for the growth of your business, you need some like basically funding, loan or cash or investment from other people to help you to grow and scale the business. So that is itself is not always bad. But if you have a very high leverage, it means that your business always get cash from financing, not from the operation. Then that's the business is very high risky to into the potential investor because if you run out all the cash from the fundings and outside funding, not from your operation, in long term, you potentially don't have enough cash to actually keep your business sustainable at all. And that is not very attractive to potential investor. And then like I can give you an example. So for example, if your business want to looking for like $500,000 in loan from the bank to expand your business operation, and they review your balance sheet and you have like $100,000 in asset, only like $10,000 in liability, that means you have a $90,000 in equity. The bank view is very favorable in terms of financial position, and it's more likely to approve for the loan because they know that okay, you actually have a cash and your liability very low. So the potential that you will be able to, and the equity is very good. It means that your business actually generate the money. And so you only face the challenge that whether you have the cash to fund the next stage of your growth, then that is very likely to be favorable for them compared with the fact that you have a life example $100,000 in asset but like $300,000 in liability. This make your equity become negative. This is very risky financial position, and because it's the company you very high leverage and may struggle to repay the loan in the future. So, I mean, like that is why the balances is very important. And most of the time, if you apply for the loan, most of the bank will ask you to give both profit and loss and the balance sheet. People will ask me, like, why some business actually have a negative equity. There's a couple reasons, but I can mention three main reasons. First, the balance sheet has a loss for many years and it's carried forward. Balance sheet is totally different than profit and loss in the way. Profit and loss by the end of the year you done for that year. You don't mention that for the last 2 years we make the profits of this on average and you count for 1 year. You call it fiscal year. But on the balance sheet, anything that you make, like for example, previous year you make a profit $50,000. That $50,000 will be carried forward on the balance sheet at a retained earning. It's not like gone away. But on the profit and loss, you don't carry the previous revenue from previous year into this year at all. So that is just a very clear difference between balances and profit and loss. So if you have a negative equity, maybe the last couple years your business didn't make a profit, and that create a negative return earning, and that negative return earning is so huge on the balances. That's why anything that profits that you make this year is not enough to cover for the previous return earning were negative. For example, if your return earning carry forward into this year totally like $500,000 in negative, a loss of $500,000 in return earning. This year you start to make the profits and the profits is $100,000. That would make you to have a negative equity on the balance sheet. Unless, of course, you put more money into the business or like any activity that have you to like increase the capital. And this is also one of the reasons why many company they actually want to raise the fund through equity fund raising rather than like a bank loan or a liability, because liability when you get the loan you need to book in cash, you increase the cash, and then you also increase the liability. That make your balances is like also obscure more toward the liability balance than the equity balance. It's like unfavorable compared to like people raise the funding. This is why they offer like go public offerings and all of this is because it's have to increase the equity part. You also have a negative of equity if you actually have too much like distribution to the shareholders or like distribution to the owner, because like you once you distribute is minus the equity out. And so the more you distribute and withhold and withdraw from your business, that make your equity in the business going down. And then the number three is you're heavily in loan and debt, like I said before. If you have a very huge loan and debt on the balance sheet, it will obscure your balances into the debt areas, because assets equal to liability plus equity. So if you have more liability, then your equity it become like negative balance. And people like say like why equity is important. It's important because if you run a business, the business make money, but at the end of the day, it doesn't create enough the profits. and doesn't generate enough cash to carry forward its operation, it will show up on the balance sheet. And the equity that is so bad in terms of negative is basically like make the business unfavorable, because there's no way why you need to invest into this business that don't generate enough cash from their operating, don't have a like the profits, and always like need more funding to carry the business forward. So that is why it's very important to like pay attention to it. And then in the balances, when you put the profit and loss and the balances together, it's very helpful because all the financial analysis that will do and have the business owner that make the better financial decision. That is when they do a financial ratio. What is a financial ratio? Basically, you divide some factor over some other factor. Like for example, over here, if you want to calculate return on your assets, you get the net income from the profits and loss, and you divide for your total assets from your balance sheet. Now you see that there is the relationship between the profit and loss and the balance sheet. And if once you do that return on assets, you will see whether company that actually use assets to generate the profits for the business. But I also think that this is very like accounting concept too in terms of this way. Because nowadays human resource is actually a part of your assets, because if you hire some like talented people, those people they are an asset. I mean, it's not like the human and belong to the company or anything, but I mean like you need talents to grow and to perform and to carry the work of your business or your mission of your business. But these talents normally, what is so on the financial report is on the payroll versus on the profit and loss. And profit and losses is become an expense unless these people actually, and in the real business world, you know that these people actually have the company generate the revenue and create the result for the business. But you don't book them into the balance sheet at an asset at all. You just book it as is spent on the profit and loss. In so many cases, if the business that face the financial challenge, people will cut the payroll first, because that is the biggest chunk of the spend that they most of the time is the biggest chunk of spend on their financial report, and they want to cut it right away. But this is your company as the business owner. You actually spend the time to measure the return on your investment on the human resource part, like from the start, that who actually perform the work and carry a lot of like daily activity and operation. That is one of the ratio that you also need to pay attention to. And then the second thing is the current ratio. Current ratio equal to current asset divided to current liability. That show the ability of the company able to pay for the short-term obligation. And this is very important. So many company and business that just run out of cash, and they basically like fail the business. It's not because they don't actually have a great idea. It's not because their idea is not working, but it's not working the speed that generate enough cash and assets for them to like pay down all of the short-term obligation. So it's very key and important that understand the state of your business, which state that you are in, and how that's correlate to your cash position, because it's happen all the time. The many business owner have a brilliant idea, and the first stage when they just exist, they doing well. Then they survive it, they doing well, but now they want to actually grow that business, and they suddenly run out of cash to actually funding for all of these like future activity that need to be done for the growth, like penetrate the market, marketing, human resource, all of these. And they run out of cash because they don't pay attention into it. So make sure that you know the cash position, and in on the balances, that is the current ratio, like whether you have enough cash to pay for the obligation short-term liability. And then the number three that people, many company and many financial analysts also pay attention is called the return on equity, which is the net income from the business divide for the shareholder equity. If you like 100% of your business is total equity that you have in the business, and that have you to understand how profits, how efficiency company relate to this equity. So, for example, if you put it in like $100,000 or $200,000 to start your business, this the company actually use that $100,000 to create the revenue, the net profits that you actually need for your business in long term. And that is where you need to like actually pay attention in how efficient and how profits the company use that equity to generate the revenue, the profits that the company need for. So I think that's the balance it. And to be honest, the balance is actually very complicated if we want to talk like in the complicated thing. But I want just to give you a very practical view. As the business owners, many of you will not prepare the balance sheet yourself, especially if your business is like on a growth stage. You have someone to actually prepare it for you. So it's very important to actually look at it and understand, okay, what is the information that you need to take away from your own balance sheet? What is your assets position? What is your liability situation? What is your equity? And if I get all the time the question that I figure out why my equity is negative, what is this ratio actually mean for my business? So that is why I gave you three reasons why your equity was negative, and also like three financial ratio that you need to pay attention anytime that you read your balance sheet. And I hope this is super helpful for you for your financial decision for your business. And let me know if you have any question. I appreciate your time today and thank you so much. I'm looking forward all future episode to share with you.